Thursday, second quarter GDP data came out in the U.S. and real GDP declined by 0.9%. This would mark the second consecutive quarter of GDP decline in the U.S., which by some technical definitions would mean we're in a recession. The question is whether or not we actually are and how gold will perform during an economic contraction. We're here to discuss this topic with Jeff Clark. He's a senior precious metals analyst at goldsilver.com. And I'm very excited to speak with you, Jeff. You've been on Kitco many times before, but it's my first time speaking with you. Welcome.
Oh, thanks for having me, David. Yeah, I appreciate it.
I appreciate your time. So yes, let's start by talking about the macroeconomic landscape, and then we'll drill down into gold and silver. So I'd just like you to comment on Jerome Powell, the Fed Chair Jerome Powell's comments from yesterday. As you know, the FOMC raised the Fed funds rate by 75 basis points. This was the largest increase since 1994 at a single meeting. And he made this remark before GDP data came out on Thursday. He said, I don't think the U.S. is currently in a recession. There are too many areas of the economy that are performing too well. I would point to the very strong labor market. It's true that growth is slowing, but generally GDP numbers are revised pretty significantly. You tend to take first GDP reports with a grain of salt. How would you respond to that?
Yes. Well, first of all, the Fed is a marketing machine, not necessarily a truth machine. I mean, one of their tools is forward guidance. So they're going to talk down bad news and try to keep the economy strong and people encouraged and not cause any kind of panic. Mm-hmm. And so that's partly what this is. Now, if you go back and look at, there's a lot of different indicators that can tell us whether the economy is in a recession or not. Some of those indicators say we are. Some of those indicators say we're not. Mm-hmm. But Mike Maloney just did a video on this the other day. And he said the bellwether indicator for determining whether we're going to go into a recession, the one that most economists and government officials and analysts use, is the 10-year yield minus the 2-year yield. Every time that figure has gone negative, we went into a recession after that. Sometimes it was right after it. Sometimes it was as long as a year and a half after that. But it just went negative last week. And so this would imply that we're headed to a recession. The reason I say that is because that indicator has predicted every single recession since 1980. Every time that figure's gone negative, a recession has followed afterward, either within a short period of time or a year or so. So whether or not we're in a recession right now, this very reliable indicator is saying a recession is coming, and which means we should all prepare for that.
Okay, so so you're talking about the yield curves. Assuming the yield curve's predictive powers hold and we are entering a recession, if not already in one, the question is whether or not the Fed should be raising interest rates at this particular juncture. It would seem illogical to raise interest rates at a time when the recession is on everybody's mind. So my question is, Jeff, do you agree with the 75 basis points hike that we saw this week?
Yeah, so the recession or the raising rates for him to lower inflation is probably not going to work because inflation is not a demand-driven thing right now. It's actually a supply-driven thing, and he can't solve that by raising rates. Eventually, that'll work, but that's not a short-term solution, just raising rates. The supply chain issue has to be resolved, and pushing rates higher is not going to work, at least in the short term. It may even make things worse in the short term. Who knows? So I don't think he has a complete grasp of exactly what is going to be required to bring inflation down. Again, they're a marketing machine, not a truth machine. I start with that basis because they've been wrong so many times in the past. And so I want to look at the data myself and see what it says. And it tells me a recession is coming, A, and B, that raising rates is not going to work in terms of taming inflation.
Well, Powell is not the only government figure who has cited the strong labor market. President Joe Biden himself has said to reporters earlier this week that because the unemployment rate is still at multi-year lows, one shouldn't discount the fact that the labor market is very strong. Therefore, we are not in a recession. So people are citing the strong labor market right now. It is indeed true that the unemployment rate is at around 3 to 4%, which is low by historic numbers. How would you respond to Powell and Biden's remarks regarding unemployment?
Yeah, unemployment is a factor that needs to be considered into that, but it's not the only factor. There are many factors that are going to tell us if we're going to go into a recession or not. Again, if I just look at the data and the things that are happening right now, not just unemployment, but many other factors, it tells me that a recession is almost certainly on the horizon, either in the short term or the long term. So either by the end of the year or sometime in 2023.
Well, Powell did justify his 75 basis point rate hike. And the Fed does seem to believe that inflation is coming back down all the way down to their 2% target in the foreseeable future. In fact, I'll just read you this quote. He says, over the coming months, we will be looking for compelling evidence that inflation will be moving to 2%. We did judge that 75 basis points was the right magnitude in light of the data. We wouldn't hesitate to make an even larger move if the committee were to conclude that was appropriate. That was not the case at this meeting. So he's signaling that even a 1% or above move could be happening in the next meeting. And he's signaling that inflation is coming back down to 2%. Let's break this down. Is inflation coming back down to 2% in the coming months, were his words?
Were those words published on Babylon B? I'm just curious because that
no, those were the meeting minutes.
Yeah, I know. I'm just saying. You mean like 2% a year ago when they said that, when inflation was going to be transitory? That just proves you right there, and yet another example. They don't have a grasp on what exactly the factors are. They're going to push this down. They have a limited number of tools, and those tools can work at times. And I'm not saying he shouldn't try to be positive and not panic, but those tools don't always work. And they are more about marketing and keeping markets calm and the economy calm and citizens calm than they are about, telling us exactly the truth and what to expect.
All right, well, let's move on to gold now, gold and silver. So before we do, actually, inflation, what is your view on inflation? So assuming you don't agree with the Fed's 2% inflation outlook over the next coming months, where do you think inflation is going instead?
I think it does remain elevated for a period of time. When it starts to fall is when the supply chain issues get resolved. When those get resolved, then inflation will start to come back down, especially because by that time rates will be high, even higher than they are now probably, and that's going to depress economic activity, and it will push us into a recession. That's pretty clear at this point, but that'll also bring inflation down. But again, it starts with the supply issue, not with the rate issue.
I see. Well, the question a lot of gold investors has been asking is why gold has not been catching up with the CPI index, at least for the last, I would say, 9 months or so. As you know, just to recap, gold has been more or less flat and slightly down on the year, while the CPI index has continuously ticked up. Let's just comment on that first, and then we have a few follow-ups.
Well, the issue there, what's going on with gold is obviously the spiking U.S. dollar. Gold is priced in dollars universally, so the spiking U.S. dollar has put serious pressure on gold. That's one of the reasons. You have the rate hikes and the mainstream believing that this aggressive stance, path by the Fed is going to tame inflation. You had a sell everything environment, dump everything in margin calls and that sort of thing. All of this pressured gold. But yes, why hasn't it kept up with inflation? So I asked myself that. So I went back to the last time that we had really high inflation, which of course was the 1970s. And I looked at the correlation between gold's movement and movement in the CPI. Yes. And the correlation is indeed very high. But what I discovered was in the latter half of the 70s during gold and silver's biggest run, there was a delay from when inflation spiked until gold and silver prices moved. Right. In gold's case, there was a delay of 1 year before it started to really rise in response to inflation. In silver's case, there was a 2-year delay before it started to move in response to higher inflation. So where we're at now, we've actually seen this before. We saw it the very last time we had really high inflation. There was a delay in gold and silver's response, but they eventually did respond, and of course, went through the roof back then.
Yeah, that's a Yeah, that's a great point, Jeff. This is another interesting fact I want to bring up and bring to your attention. Gold has been very much correlated with inflation expectations. If you want to measure that with the Treasury Inflation Protection Security TIPS, in fact, there's a near perfect correlation. One could argue that let's just take a look at the chart. The TIPS has spiked earlier in the year, late last year actually. It's come back down and it's hovered around a multi-month low. So inflation expectations have actually been coming down. Gold's been very well correlated with the inflation expectations, not so much CPI itself. One could possibly argue, Jeff, that gold may be a leading indicator for inflation. Gold has run up a lot last year. It's already priced in a lot of the inflation we've seen, and now the markets are saying inflation's peaked, gold's come back down. What do you think?
That's possible. Of course, there are a lot of other issues that impact the gold price, not just inflation.
Sure.
But that near perfect correlation you're talking about is true because gold did run up the year before inflation started rising strong. And then what were we all told? Inflation is transitory. There were a lot of gold analysts that were convinced inflation was going to be transitory. Therefore, why would gold rise? You don't need it because inflation is going to come right back down. So there's a strong correlation there. But I think in the big picture, I'm not looking at just the inflation issue. I'm looking at any type of crisis that's going to push more and more investors into the gold market. And I think it's more of a monetary issue for me, fiscal, financial, market. It's all those things combined that are going to eventually push gold up higher that a lot of us think it's going to, a lot of us have thought for a long time it was going to do.
There's no bigger crisis that impacts the everyday person more directly than a recession or even worse, an economic depression. So let's talk about that. How has gold performed in prior recessions, Jeff? You've done research on this area.
Yeah, I went back and looked at every single recession over the past 50 years. There's been 8 of them in the U.S., and gold, perhaps unsurprisingly, has risen in most of them. It's risen in 6 of the last 8 recessions over the past 50 years. In the 2 that it declined, the declines were very mild, like single digits. So if we're going into a recession, again, measuring the specific time of the recession, gold has risen much more often than it has fallen. So it does serve as a hedge during a recession, which makes sense because economic slowdowns cause uncertainty, maybe some fear, whatever, and people will go into gold. That's not surprising. What was surprising is that it's the only precious metal that really responds that way. Silver, platinum, palladium, they all actually do very poorly during a recession. Silver is just the opposite of gold. It's fallen in 6 of the last 8 recessions, and the 2 rises were not that big. The same with platinum and palladium. They've fallen in every single recession, the last 8 over the last 50 years, except 1. So gold really is the king metal. It is money, and that's why people rush to it, during periods of economic slowdown and economic uncertainty.
There's also excellent point. So there's also, I'm just looking at the DXY, just looking at the past 2 recessions, so not counting 2020, but 2008 and 2001, the dollar fell during those 2 recessions. That may possibly also, like you said, that might also have contributed to gold's strong performance in prior recessions. Do you think the dollar can remain strong in this coming recession, Jeff?
Yeah, it could. That's the $1 million question, right? Because if it does, that's going to put pressure on everything, including gold.
Yes.
I think if the dollar continues to rise like this, like it has been, and just keeps going, that's going to cause havoc globally, not just in the U.S. So that's going to be a very interesting issue. In fact, that could even lead to the final crisis, let's say, that knocks the U.S. dollar off its reserve currency of the world status. So that's something that could is going to have an impact going forward. Gold and the dollar can rise together. There are times when it's done that. It depends on what the type of crisis is that's happening at the time. Looking at the whole picture, it's not just about the dollar. It's about a lot of other things, and that's why I remain staunchly bullish on gold.
There's one final piece of research that you've done that I'd like to touch on, which is the comparison between gold and housing prices. This is an area of research that I find personally very fascinating. What is your conclusion here from your research?
Went back and looked at how many ounces of gold it takes to buy the average price in the U.S. I've done this research for a while, and I update it every year to see if there's much change. And it's really fun to look at because it can really give you some insightful ways to maybe handle this. So if you go back to 1980, you could buy the average priced home in the U.S. for 75 ounces of gold.
Mm-hmm.
In 2011, when gold rose high then, you could buy the average priced home for 118 ounces of gold. Right now, it takes over 200 ounces of gold to buy the average priced home in the U.S. So that ratio could fall by half and not be, out of the norm. So you could see that ratio fall by 2/3, even just to get back down to where it was in 1980. And I think that is exactly what happens is because real estate's bubbly, and the raising rates is making real estate more unaffordable. It's lowering demand, which is going to lower prices. So you're going to have real estate prices coming down. Ultimately, over the next 2 to 3 years, you're going to have much higher gold prices, and that's going to bring that ratio down. So I think that's exactly what happens. So the next couple of years, maybe you can buy a new home or a second home or a vacation home or a beachfront condo if you use gold. If you rely on cash in the bank, that has depreciating value, whereas gold's going to have appreciating value.
So you're saying that it used to cost 75 ounces of gold to buy one home in the early 80s, and now it costs a lot more ounces of gold. So gold has depreciated, I guess, relative to real estate. One could argue then that gold has not served as a long-term inflation hedge just by looking at that data. Could you make that argument?
No, because the ratio pops up and then it falls back down. It cycles just like everything else, right? Like I said, in 2011, it fell all the way down to 118 ounces when gold rose. And in fact, by the way, back in 1980, what was happening? We had high inflation and we had rising real estate prices. Even with that, the ratio fell dramatically because the gold price rose a lot more. So it's two things happening, but you can have just the gold price rising to make it more affordable. So I think that's where we're ultimately headed. I think the next 2 to 3 years for gold owners is not only going to provide protection, but could be a lot of fun in what you could use it for.
Let me ask you this hypothetical question then. Let's say I'm a homeowner and you've got a bunch of gold and we're going to make a transaction. I'm selling my house to you, Jeff, and you want to buy my house with just ounces of gold, not US dollars, but just gold bars. 10 years later, who's going to have the better deal, me or you?
That's a good question. I have to think about that. But I think in the next 5 years, the person with the gold is going to have the better deal. You're kind of buying high now if you're buying real estate in gold, because gold is lower, real estate's higher. So that ratio is going to improve for gold owners over the next, let's say 3 to 5 years. 10 years out, that's a little harder to predict. But it depends on what happens to the monetary system.
Yeah, that's fair. All right, well, finally, I know you don't like to give exact price predictions, but can you at least give us a direction of where gold's headed over the next year or so?
Since everybody watches the Fed, I think the Fed is, I'll base my answer on that. I think the Fed is going to raise rates probably one more time. There'll probably be a pause. And the amount of time from when they last raise rates to when they actually start lowering rates again, the average time frame historically has only been about 6-7 months. So by next spring, you could see the Fed making a complete about face and lowering rates again, and perhaps even printing more currency. You put that combo back together, all the other things that are maybe going on at the time, you're going to have much higher gold prices. So we will see new record highs in the gold price. I don't know if we'll get them by the end of the year, but I expect gold to be much higher than where it is now by the end of the year. But by 2023, I have a high level of confidence we'll see new record highs in the gold price.
2023. All right. Well, that I guess quells some doubts in a lot of gold investors' minds. Thank you for your comments today, Jeff. I appreciate your time.
Yeah, that's recency bias, though. If you think gold can't make a new high, because it's been weak recently, you have to look out big picture, look at the fundamentals, look at the factors that could push it higher and what is more likely to happen.
Mm-hmm.
That's what I'm basing it on.
True, yes. And actually, another important point is that gold relative to other currencies besides the US dollar is already at new highs.
Yes.
Am I right?
That's very true. Gold has risen in all other major currencies more than it has in the US dollar over the past year or so. So they're already experiencing record high gold prices. The US dollar price will catch up.
Okay. All right, very good. Jeff, let's have you back on again to update us when the gold market moves. And thank you for coming on today.
Thank you, David. It was fun.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more, and don't forget to subscribe to our YouTube channel.